Okay, so welcome to lecture number 10 of STAT 761. Today we're going to look at an important, well, first we're going to look at bounds for puts and calls, American puts and American calls, and European puts and American and European calls. And also we will go through a very important relationship that relates puts and calls, the values of puts and calls, known as put-call parity. So without further ado, I will go to your chapter 11 and start reading. Okay, so properties of stock options. Let me go over here. So in this chapter, we look at the factors affecting stock option prices. We use a number of different arbitrage arguments to explore the relationship between European option prices, American option prices, and the underlying stock price. The most important of these relationships is put-call parity, which is a relationship between the price of a European call option, the price of a European put option, and the underlying stock price. The chapter examines whether American options should be exercised early. It shows that it is never optimal to exercise an American call option on a non-dividend paying stock prior to the option's expiration, but that under some circumstances, the early exercise of an American put option on such a stock is optimal. When there are dividends, it can be optimal to exercise either calls or puts early. Okay, so let's look at that. So there are 6 factors affecting the price of a stock option. This is the current stock price S0, the strike price K, the time to expiration T, the volatility of the stock price sigma, the risk-free interest rate R, the dividends that are expected to be paid. In this section, we consider what happens to option prices when there is a change to one of these factors with all the other factors remaining fixed. The results are summarized in table 11.1, so let's look at that. So according to this table, if the current stock price increases, the European call price increases. That we expect because its payoff is ST minus K. The European put is the maximum of ST minus K and 0, okay, so yes. So as the current stock price increases, European call increases. The European put decreases because its payoff is maximum of K minus ST and 0. American call, for the same reason, increases when the current stock price increases. It's an increasing function of the stock price. And the American put decreases when the current stock price increases. So with the strike price, as the strike price increases, remember the European call gives you the right, but not the obligation to buy at the strike price. So as the strike increases, the European call price decreases. And the European put, obviously, it gives you the right to sell at the strike price. So as the strike price increases, the higher the price of the European put, and the same holds true for American call and American put. As the time to expiration increases, it's unknown what is the effect on the European call and the European put. But the European call, the American call and the American put both increase in price because they have more options. More options are available on dates on which to exercise the option. As volatility increases, this increases the European call price and the European put price, and the American call price and the American put price. And the reason for this is something we're going to see in a second, but roughly speaking, volatility allows for extreme events. So the upside, for instance, is you make money on the upside of the stock if it's a European call, but it also increases the probability of the downside. So stock going down, for instance, that would increase the European put, the value of the European put. The same holds true for American call and American put. So when the risk-free rate increases, when everything else remains the same, the European, it's not obvious to see, but that is what happens, is that as the risk-free rate increases, the European call price increases, the European put price decreases, the American call price increases, and the American put price decreases. As the amount of future dividends increases, the European call decreases, because that brings down the value of the stock, obviously. So if it brings down the value of the stock and it has positive relationship with the stock, obviously it will have a negative relationship on the amount of future dividends. And the European put, it's the opposite, right? So if the future dividends decrease the price of the stock, then it has a positive effect on the European put. And the same holds true for American call and American put. And let's go and examine each and every one of these cases one by one. So figures 11.1 and 11.2 show how European call and put prices depend on the first 5 factors in the situation where S0 is 50, K is 50, R is 5% per annum, sigma is 30% per annum, and T is equal to 1, and there are no dividends. So in this case, the call price is 7.116 and the put price is 4.677. So let's see figures 11.1 and 11.2. So we see the effect of changes. So as the call option, as the stock price increases, we see that the call option price increases, as we saw before. As the stock price increases, the put option price decreases, as we can see over here. As the strike price increases, the call option price decreases. As the strike price increases, the put option price increases. As the time to expiration increases, the call option price increases, and the put option price also increases. Okay, that's figure 11.1, and let's go to figure 11.2. And we see here, as the volatility increases, the call option price increases, so does the put option price. As the risk-free rate increases, the call option, everything else remaining the same, which of course is not always true, because when risk-free rate increases, then stock prices decrease, and the opposite holds true if risk-free rates decrease. So anyway, that effect is not seen in these pictures. We are thinking that we're keeping everything else the same, constant. And so we see that the call option price increases, not by a lot, by a little bit, when the risk-free rate increases, and put option prices decrease when the risk-free rate increases. Okay, so let's look at each and every one of these relationships slowly. So stock price and strike price. If a call option is exercised at some future time, the payoff will be the amount by which the stock price exceeds the strike price. Call options therefore become more valuable as the stock price increases and less valuable as the strike price increases. For a put option, the payoff on exercise is the amount by which the strike price exceeds the stock price. So put options therefore behave in the opposite way from call options. They become less valuable as the stock price increases and more valuable as the strike price increases. The figures illustrate the way in which put and call prices depend on the stock price and strike price, as we can see over here. As the stock price increases, call option increases, put option decreases. As the strike price increases, the call option decreases, put option increases. Okay. Time to expiration. Now consider the effect of the expiration date. Both put and call American options become more valuable, or at least do not increase in value, as the time to expiration increases. Consider two American options that differ only as far as the expiration date is concerned. The owner of the long life option has all the exercise opportunities open to the owner of the short life option and more. The long life option must therefore always be worth at least as much as the short life option. Although European put and call options usually become more valuable as the time to expiration increases, this is not always the case. Consider two European call options on a stock, one with an expiration date in 1 month and the other with an expiration date in 2 months. Suppose that a very large dividend is expected in 6 weeks. The dividend will cause the stock price to decline so that the short life option could be worth much more than the long life option. Okay, so it's not clear what happens there, it depends on the dividend. Volatility, the precise way in which volatility is defined is explained in chapter 15, but basically, roughly speaking, the volatility of a stock price is a measure of how uncertain we are about stock price movements. As volatility increases, the chance that the stock will do very well or very poorly increases. For the owner of a stock, these two outcomes tend to offset each other. However, this is not so for the owner of a call or a put. The owner of a call benefits from price increases, but has limited downside risk in the event of price decreases, because the most the owner can lose is the price of the option. Similarly, the owner of a put option benefits from price decreases, but has limited downside risk in the event of price increases. The values of both calls and puts therefore increase as volatility increases. And we see this in figures 11.2 A and B, as we can see. So both call option and put option prices increase as volatility increases. Okay. Okay. So the risk-free interest rate, okay. So the risk-free interest rate affects the price of an option in a less clear-cut way. As interest rates in the economy increase, the expected return required by investors from the stock tends to increase. In addition, the present value of any future cash flow received by the holder of the option decreases. The combined impact of these two effects is to increase the value of a call option and decrease the value of put options. Okay, and this is seen in this graph over here, this graph and this graph. It is important to emphasize that we are assuming that interest rates change while all other variables stay the same. In particular, we are assuming in table 11.1 that interest rates change while the stock price remains the same. So in here, we assume that everything else stays the same, and the risk-free rate is the only one that changes, but that's not what usually happens, as is explained in the next paragraph. It is important to emphasize that we're assuming that interest rates change while all other variables stay the same. We are assuming that interest rates change while the stock price remains the same. In practice, when interest rates rise, stock prices tend to fall. When interest rates fall, stock prices tend to rise. The combined effect of an interest rate increase and the accompanying stock price decrease can be to decrease the value of a call option and increase the value of a put option. Similarly, the combined effect of an interest rate decrease and the accompanying stock price increase can be to increase the value of a call option and decrease the value of a put option. So that's what usually happens. So the amount of future dividends. So dividends have the effect of reducing the stock price on the ex-dividend date. This is bad news for the value of call options and good news for the value of put options. Consider a dividend whose ex-dividend date is during the life of an option. The value of the option is negatively related to the size of the dividend if the option is a call, and positively related to the size of the dividend if the option is a put. Okay, that's to be expected because of the effect of dividends on the stock price. Okay, so we see this in the table. Amount of future dividends has a negative effect on European call, positive effect on European put, negative effect on American call, and positive effect on American put. Okay, let's stop sharing and go to our slides. Okay. So properties of stock prices. So the notation is C is a European call option, P is a European put option, S0 is the stock price today, K is the strike price, T is the life of the option, sigma is the volatility of stock price, C, capital C is the American call option price, P is the American put option price, ST is the stock price at option maturity, D is the present value of dividends paid during the life of the option, and the risk-free rate is R with continuous compounding. And so this is the effect of each of the variables on option. As we can see, when S0 rise, call option price increases, put option decreases. American call increases, American put decreases. When K rises, call option decreases, put option increases, same for American call and put. When time to maturity increases, it's unclear what happens to call option and put option, European put and call. But for American call and put, since you have more options on when to exercise, the value increases for both of them. If the volatility increases, this has the effect of increasing the values of all calls and puts, American or European, as we just saw. As the interest rate increases, it has the effect of increasing effect on calls, all others being the same, which is not always true actually. As interest rates increase, stock prices decrease. So the net effect on call option prices would be to decrease. But now we assume that stock prices remain the same, risk-free rate increases, call option price decreases, put option price decreases, American call increases, and American put decreases. Dividends have the opposite effect on call option prices because they decrease the value of the stock. So for the same reason, they have a positive effect on put options, and the same for American calls and puts. So with American versus European options, an American option is always worth at least as much as the corresponding European option. And the same holds true for calls or puts. So let's stop sharing and go back to our slides, to our book. So assumptions and notations. So in this chapter, we will make assumptions similar to those made when deriving forward and futures prices in chapter 5. We assume that there are some participants, such as large investment banks, for which the following statements are true. There are no transaction costs. All trading profits, net of trading losses, are subject to the same tax rate. borrowing and lending are possible at the risk-free interest rate, we assume that these market participants are prepared to take advantage of arbitrage opportunities as they arise. As discussed in chapters 1 and 5, this means that any available arbitrage opportunities disappear very quickly. For the purposes of our analysis, it is therefore reasonable to assume that there are no arbitrage opportunities. So we will use the following notation, as 0 is the current stock price, K is the strike price of the option, T is the time to expiration of an option, ST is the stock price on the expiration date, R is continuously compounded risk-free rate of interest for an investment maturing in time T. Value C is the value of the American call option to buy one share. P is the value of the American put option to sell one share. C is the value of European call option to buy one share. P is the value of the American put option to sell one share, so lowercase p. It should be noted that R is the nominal risk-free rate of interest, not the real risk-free rate of interest. The proxies used by the market for the risk-free rate of interest were discussed in section 4.3. So we saw what that risk-free rate really means. So the risk-free rate of interest, so the real rate of interest is the rate of interest earned after adjustment for the effects of inflation. For example, if the nominal rate of interest is 3% and inflation is 2%, the real rate of interest is approximately 1%. Okay. So a simple arbitrage argument suggests that R is greater than 0, and this is the assumption we make in deriving results in this chapter. However, during some periods, the monetary policies of government have led to interest rates being negative in some currencies, such as the euro, Swiss franc, and Japanese yen. But okay, at this moment, we assume that R is greater than 0. So we derive upper and lower bounds for option prices. These bounds do not depend on any particular assumptions about the factors mentioned in section 11.1. If an option price is above the upper bound or below the lower bound, then there are profitable opportunities for arbitrageurs. So let's see. An American or European call option gives the holder the right to buy one share of a stock for a certain price. No matter what happens, thus, the option can never be worth more than the stock. Hence, the stock price is an upper bound to the option price. And this is true for both American and European calls. If these relationships were not true, an arbitrager could easily make a riskless profit by buying the stock and selling the call option. Okay. An American put option gives the holder the right to sell one share of a stock for K. No matter how low the stock price becomes, the option can never be worth more than K. Hence, P, the price of an American put, is less than or equal to K. For European options, we know that at maturity, the option cannot be worth more than K. It follows that it cannot be worth more than the present value of K today. So the price of a European put option is always less than or equal to the discounted price of K, the discounted value of K. If this were not true, an arbitrager could make a riskless profit by writing the option and investing the proceeds of the sale at the risk-free interest rate. Okay, so lower bounds for calls on non-dividend paying stocks. A lower bound for the price of a European call option on a non-dividend paying stock is S0 minus K e to the minus RT. We first look at a numerical example and then consider a more formal argument. So let's look at this. So suppose that S0 is $20, K is equal to $18, R is equal to 10% per annum, and T is equal to 1 year. In this case, S0 minus K to the minus RT, it's 20 minus 18 e to the minus 0.1, which is 3.71. Consider the situation where the European coal price is $3, which is less than the theoretical minimum of $3.71. The arbitrager can short the stock and buy the coal to provide the cash inflow of 20 minus $3, which is $17. If invested for 1 year at 10%, the $17 grows to $18.71. At the end of the year, the option expires. If the stock price is greater than $18, the arbitrager exercises the option, paying $18 for the stock, and uses the stock to close out the short position. This leads to a profit of $18.79 minus 18, which is 79 cents. If the stock is less than $18, the stock is bought in the market, the stock is bought in the market and the short position is closed out. The arbitrager then makes an even greater profit. For example, if the stock price is $17, the arbitrager's profit is $18.79 minus $17, which is $1.79. Okay, and we can see a more formal argument, but we can just go to the book, to the slides. So suppose that C is equal to 3, T is equal to 1, K is equal to 18, S0 is 20, R is equal to 10%, the dividend is equal to 0. Is there an arbitrage opportunity as we just saw in the book? Indeed, there is. Let's go. So then a lower bound for European call option price with no dividends is actually the max of S0 minus K to the minus RT. We will see exactly how that is derived in a second. Okay, so for a more formal argument, we consider the following two portfolios. One European call plus a zero coupon bond that provides a payoff of K at time T. And portfolio B, one share of the stock. In portfolio A, the zero coupon bond will be worth K at time T. If ST is greater than K, the call option is exercised at maturity and portfolio A is worth ST. If ST is less than K, the call option expires worthless and the portfolio is worth K. Hence, at time T, portfolio A is worth the maximum of ST and K. Portfolio B is worth ST at time T. Hence, portfolio A is always worth as much as and can be worth more than portfolio B at the option's maturity. It follows that in the absence of arbitrage opportunities, this must also be true today. So the zero coupon bond is worth K to the minus RT today, and hence C plus K to the minus RT has to be greater than or equal to S0, or in other words, the price of the call option should be greater than or equal to S0 minus K to the minus RT. Because the worst that can happen to a call option is that it expires worthless, its value cannot be negative. This means that the call option is greater or equal to 0, and so that the call option is definitely always greater than or equal to the maximum of S0 minus K to the minus RT and 0, which we just saw in the slides. So if we consider a European call option on a non-dividend paying stock, when the stock price is $51, the strike price is $50, the time to maturity is 6 months, and the risk-free rate is 12% per annum. In this case, we have S0 is equal to 51, K is equal to 50, T is equal to 0.5, R is equal to 0.12. And so we can easily apply 11.4, equation 11.4, and then we can find that the lower bound for the option price is S0 minus K to the minus RT, which is $3.91. The maximum of $3.91 and zero, which is $3.91. So let's go back to the slides now. So we just show how this bound is established. So puts now. So suppose that P is equal to 1, T is equal to 0.5, K is equal to 40, S0 is equal to 37, R is 5%, and the dividend is equal to 0. And the question is there an arbitrage opportunity? And the answer is that there is. And let's go to the book to see how we can construct an arbitrage opportunity in this case. So for a European put option on a non-dividend paying stock, a lower bound for the price is K to the minus RT minus S0. So again, consider a numerical example and then look at the more formal argument. So suppose that the 0 is 37, K is equal to 40, R is 5% per annum, and T is equal to 0.5 years. In this case, the lower bound turns out to be $2.01. So consider the situation where the put, where the European put price is $1, which is less than the theoretical minimum of $2.01. An arbitrager can borrow $38 for 6 months to buy both the put and the stock. Okay, both the put and the stock, which is $1 plus $37, so that's $38. At the end of the 6 months, the arbitrager will be required to repay the loan of $38 at the 5% rate, okay, which is $38.96. If the stock price is below $40, the arbitrager, if the stock, if the stock price is below $40, the arbitrager, so if the stock price is below $40, then the arbitrager exercises the option to sell the stock at $40, repays the loan, and makes a profit of 40 minus 38.96, which is $1.04. If the stock price is greater than 40, the arbitrager discards the option, sells the stock in the stock market, and repays the loan for an even greater profit. For example, if the stock price is $42, the arbitrager's profit is $42 minus 38.96, which is $3.04. So we see that indeed, in this case, there is an arbitrage opportunity, and the reason is that basically K to the minus RT minus S0 constitutes a lower bound to the price of a put. Okay. So let's go back to the slides. We just saw that there is an arbitrage opportunity if these are the parameters given. And so the lower bound for European put prices with no dividends is basically K to the minus RT minus S0 and 0. And we can actually see a more formal argument that derives this in a couple of seconds. Okay. So consider the following two portfolios. Portfolio C is one European put option plus one share. Portfolio D is a zero coupon bond paying off K at time T. If ST is less than K, then the option in portfolio C is exercised at option maturity and the portfolio becomes worth K. If ST is greater than K, then the put option expires worthless and the portfolio is worth ST at this time. So hence the portfolio C is worth max of ST and K in time T. Portfolio D, which is a zero coupon bond paying off K at time T, is worth K in time T. Hence portfolio C is always worth as much as and can sometimes be worth more than portfolio D in time T. It follows that in the absence of arbitrage opportunities, C must be worth at least as much as portfolio D today. Hence, P plus S0 has to be greater than or equal than the present value of K at time T, which is K to the minus RT, which basically gives you the lower bound that the put is at least K to the minus RT minus S0. Because the worst that can happen to a put option is that it expires worthless, its value cannot be negative. And this means that P is greater than the max of K to the minus RT minus S0 and 0. So we consider a European put option on a non-dividend paying stock when the stock price is $38, the strike price is $40, the time to maturity is 3 months, and the risk-free rate of interest is 10% per annum. In this case, S0 is 38, K is equal to 40, T is equal to 0.25, and R is equal to 10%. From this equation 11.5, a lower bound for the option price is K e to the minus RT minus S0, which is 40 e to the minus 0.1 times 0.25 minus 38, which is $1. So we continue with put call parity. So let's go back to our slides. So we consider, so let's look at this now. We consider two portfolios. Portfolio A is a European call on a stock plus zero coupon bond that pays K at time T. And portfolio C is a European put on the stock plus the stock. So let's go back to the book and see what we do with these portfolios. Okay, so once again, we now derive an important relationship between the price of European put and call options that have the same strike and time to maturity. So consider the following two portfolios that were used in the previous section. The first one is one European call option plus a zero coupon bond that provides a payoff of K at time T, and portfolio C, which is one European put option plus one share of the stock. Okay. Portfolios illustrating put call parity. So portfolio A is a call option. So if ST is greater than K, the call option is going to expire at ST minus K. The zero coupon bond is going to expire at K. The total of the two is ST. If ST is less than K, the call option will expire worthless, and the zero coupon bond will again be worth K, and the total will be K. So portfolio C, the put option, if ST is greater than K, is going to expire worthless. The share is going to be worth ST at expiry. If ST is less than K, then the put option is going to be worth K minus ST. The share will be worth ST. The sum of these two is K, and the sum of these two over here is ST. So these two portfolios have to be worth the same at time zero as well, not just at X period. That's basically the idea. So let's look at what it says over here. We continue to assume that the stock pays no dividends. The call and put options have the same strike price K and the same time to maturity T. So as discussed in the previous section, the zero coupon bond in portfolio A will be worth K at time T. If the stock price ST at time T proves to be above K, then the call option in portfolio A will be exercised. This means that portfolio A is going to be worth ST minus K plus K, which is ST at time T, and in these circumstances. If ST proves to be less than K, then the call option in portfolio A will expire worthless, and the portfolio will be worth K at time T. In portfolio C, the share will be worth ST at time T. If ST proves to be below K, then the put option in portfolio C will be exercised. This means that portfolio C is worth K minus ST plus ST, which is equal to K at time T in these circumstances. If ST proves to be greater than K, then the put option in portfolio C will expire worthless and the portfolio will be worth ST at time T. The situation is summarized in table 11.2. If ST is greater than K, both portfolios are worth ST at time T. If ST is less than K, both portfolios are worth K at time T. In other words, both are worth the maximum of ST and K when the options expires at time T. Because they are European, the options cannot be exercised prior to time T. Since the portfolios have identical values at time T, they must have identical values today. If this were not the case, an arbitrager could buy the less expensive portfolio and sell the more expensive one. Because the portfolios are guaranteed to cancel each other out at time T, this trading strategy would lock in an arbitrage profit equal to the difference in the values of the two portfolios. The components of portfolio A are worth C, and so C from the call option, and K to the minus RT from K at time T, and time capital T, which is worth K to the minus RT today. And the components of portfolio C are worth, which is the put option plus the share, is going to be P plus S0 today. Hence, we have to have C plus K to the minus RT equal to P plus S0. This relationship is known as put-call parity. It shows that the value of a European call with a certain exercise price and exercise date can be deduced from the value of a European put with the same exercise price and exercise date, and vice versa. To illustrate the arbitrage opportunities when equation 11.6 does not hold true, suppose that the stock price is $31, the exercise price is $30, the risk-free rate is 10% per annum, the price of a 3-month European call is $3, and the price of a 3-month European put is $2.25. In this case, C plus K to the minus RT is $32.26. P plus S0 is 225 plus 31, which is 33.25. Portfolio C is overpriced relative to portfolio A. An arbitrager can buy the securities in portfolio A and short the securities in portfolio C. The strategy involves buying the call. The strategy involves then is going to be buying the call, shorting both the put and the stock, generating a positive cash flow of -3 plus 225 plus 31, which is $30.25 up front. When invested at the risk-free interest rate, this amount grows to $31.02 in 3 months. If the stock price at expiration of the option is greater than $30, the call will be exercised. If it is less than $30, the put will be exercised. In either case, the arbitrager ends up buying one share for $30. This share can be used to close out the short position, and the net profit is therefore 31.02 minus 30, which is $1.02. For an alternative situation, suppose that the call price is $3 and the put price is $1. In this case, C plus K to the minus RT ends up being $32.26. P plus S0 turns out to be $32. And now portfolio A is overpriced relative to portfolio C. An arbitrager can short the securities in portfolio A and buy the securities in portfolio C to lock in a profit. The strategy involves shorting the call and buying both the put and the stock with an initial investment of $31, because you are shorting the call. So $31. So plus $1 minus $3. Okay. The initial investment is $29. When the investment is financed at the risk-free, so this is the price of the put, this is the price of the call, okay? And this is the stock itself, the underlying stock price, okay? So the initial investment is 31 plus $1, 31 plus $1 minus $3 because you're shorting the call, which is $29. So when the investment is financed at the risk-free interest rate, a repayment of 29 e to the 0.1 times 0.25, so $21,973 is required at the end of the 3 months. As in the previous case, either the call or the put will be exercised. The short call and the long put option position therefore leads to the stock price being sold for $30, and the net profit is therefore $30 minus $29.73, which is 25.7 cents. So these examples are illustrated in table 11.3. We will see it in a second. And business snapshot 11.1 shows how options and put call parity can help us understand the positions of the debt holders and equity holders in a company. So let's look at the arbitrage opportunities. Actually, let's stop sharing and look at what our slides have to tell us. So we consider the two portfolios, which is European call on the stock plus zero coupon bond that pays K at time T, and European put on the stock plus the stock. And we see that they're worth the same at expiry, so they have to be worth the same at inception. And from there comes the put call parity. Yeah, you see, so then call option plus zero coupon bond. The call option is ST minus K if ST is greater than K, 0 if ST is less than K. Zero coupon bond is worth K in either case. Total is ST minus K plus K ST if ST is greater than K, and it's K if ST is less than K. Then portfolio C, which is put option plus the share, is going to expire worthless if ST is greater than K, plus the share which is ST, the total is S capital S sub T. And the put option is K minus ST. The put option is K minus ST, and the share, if ST is less than K, and the share is ST, so the total is K when ST is less than K. So these are portfolios that have identical payoffs at expiry, so they will have to be equal at inception, and that's what gives us put call parity. So both are worth max of STK at the maturity of the options. They must therefore be worth the same today. This means that call option plus the value of K of the bond, present value of that today, should be equal to put option plus stock at inception. And so we saw that there are arbitrage opportunities here if this relationship, which is the put call parity, excuse me. So if this put call parity doesn't hold, then we have arbitrage opportunities, and we just saw what those arbitrage opportunities are when P is 225 and when P is equal to 1. We just saw that in the book. So we can go through this again. So the 3-month put price is, this is the summary table. Okay. And so the action now, so if the 3-month put price is $2.25, the action now is buy a call for $3, short the put to realize $2.25, short the stock to realize $31, invest $30.25, which is 31 plus 225 minus 3, okay? So that you invest in 30.25 for 3 months. The action in 3 months, if ST is greater than 30, is that you receive 31.02 from the investment, exercise call to buy the stock for $30, and you have a net profit of $1.02. If ST is less than 30, you receive 31.02 from the investment. The put is exercised, so you buy the stock for $30, and the net profit is again $1.02. If the 3-month put price is $1, then what you do now is you borrow $29 for 3 months, you short the call to realize $3, you buy the put for $1, and you buy the stock for $31. Okay, so the $29 is enough to make you be able to set up this portfolio. The $29, it's minus, so 31 plus 1 minus 3, that makes 29. Okay, so $29, you borrow the $29 and that's enough for you to short the call, buy the put, and buy the stock. And then the action in 3 months is if ST is greater than 30, you have the call being exercised. So you sell the stock for $30 and you use $29.73 to repay your loan. Your net profit is 27 cents. If the action in 3 months, if the ST is less than 30, then what you do is you exercise the put to sell the stock for $30. You use $29.73 to repay the loan, and you again have pocketed 27 cents. So this is what happens when put call parity doesn't hold. Okay, so we saw that. Let's go back. So we saw that there's arbitrage opportunities both when P equals to 25 and P is equal to 1. And so now this is about early exercise of an American option on a non-dividend paying stock. So we haven't reached there yet. So let's go back to our book. So before we go to American option, to early exercise of American options, so put call parity holds only for European options. However, it is possible to derive some results for American options. It can be shown that when there are no dividends, actually, the call option minus the put option is less than or equal to S0 minus K to the minus RT, and that is also greater than or equal to S0 minus K. An American call option on a non-dividend paying stock with strike price $20 and maturity in 5 months is worth $1.50. Suppose that the current stock price is $19 and the risk-free interest rate is 10% per annum. From equation 11.7, okay, which is right here, we have an upper and lower bound. The 19 minus 20 is the lower bound for C minus P, and the upper bound is 19 minus 20 e to the minus 0.15 over 12, which gives me that the put minus the call is upper bounded by 1 and lower bounded by 0.18. So that P minus C lies between $1 and 0.18 and 18 cents. With C at 150, P must lie between 168 and 250. In other words, upper and lower bounds for the price of an American put with the strike price and expiration date as the American call are 250 and 168. So all these quantities basically can, all these quantities are the price of the American call and American put are somehow related to one another. So let's talk about calls on a non-dividend paying stock. Give me a second. I will have to charge my. So there. So let's go back to the book. So we have calls on a non-dividend paying stock. In this section, we first show that it is never, it is never optimal to exercise an American call option on a non-dividend paying stock before the expiration date. To illustrate the general nature of the argument, you consider an American call option on a non-dividend paying stock with 1 month to expiration when the stock price is $70 and the strike price is $40. The option is deep in the money, and the investor who owns the option might well be tempted to exercise it immediately. However, if the investor plans to hold the stock obtained by exercising the option for more than 1 month, this is not the best strategy. A better course of action is to keep the option and exercise it at the end of the month. The $40 strike price is then paid out 1 month later than it would be worth if the option were exercised immediately. So that interest earned and that interest is earned on the $40 for 1 month, because the stock. So the $40 that you had in store to basically buy the stock at $40 can earn interest for that 1 month period. Because the stock pays no dividends, no income from the stock is sacrificed. A further advantage of waiting rather than exercising immediately is that there is some chance, however remote, that the stock price will fall below $40 in one month. In this case, the investor will not exercise in 1 month and will be glad that the decision to exercise early was not taken. Okay. This argument shows that there are no advantages to exercising early if the investor plans to keep the stock for the remaining life of the option, 1 month in this case. What if the investor thinks the stock is currently overpriced and is wondering whether to exercise the option and sell the stock? So in this case, the investor is better off selling the option than exercising it. the option will be bought by another investor who does want to hold the stock. Such investors must exist, otherwise the current stock price would not be at $70. The price obtained for the option will be greater than its intrinsic value of $30 for the reasons mentioned earlier. Okay, so for a more formal argument, we can use the equation that we had before, which is that the call option price, European call option price, is greater than S0 minus K to the minus RT, because the owner of an American call has all the exercise opportunities open to the owner of the corresponding European call. We have that the American call is worth at least as much as the European, so that the American call is bounded below by S0 minus K to the minus RT. Given R is greater than 0, it follows that the call is in fact greater than S0 minus K. And when T is greater than 0, this means that C is always greater than the option's intrinsic value prior to maturity. If it were optimal to exercise at a particular time prior to maturity C, C would equal the option's intrinsic value at that time. It follows that it can never be optimal to exercise early. So there are two reasons an American call on a non-dividend paying stock should not be exercised early. One relates to the insurance that it provides. A call option, when held instead of the stock itself, in effect insures the holder against the stock price falling below the strike price. Once the option has been exercised and the strike price has been exchanged for the stock price, the insurance vanishes. The other reason concerns the time value of money. From the perspective of the option holder, the later the strike is paid out, the better. Okay, so let's stop sharing. So usually there is some chance that an American option will be exercised early. An exception is an American call on a non-dividend paying stock. This should never be exercised early. So for an American call option, S0 is 100, T is equal to 0.25, K is equal to 60, D is equal to 0. Should you exercise immediately? The answer is no. This is a non-dividend paying stock. What should you do if you want to hold the stock for the next 3 months? The answer is buy the stock. And you do not feel that the stock is worth holding for the next 3 months. What do? Is you basically close out your option contract. Okay, your call option contract. Okay. So then, okay, so that's fine. So the reasons for not exercising a call early when there's no dividends is that there's no income that is sacrificed and you delay paying the strike price. Holding the call provides insurance against stock price falling below the strike price. Okay. So bounds for European or American call options. So we will see that in a second. Okay. So again, we saw so what if the investor thinks the stock is currently overpriced and is wondering whether to exercise the option and sell the stock? In this case, the investor is better off selling the option than exercising it. So we saw that over here one more time. You do not feel the stock is worth holding for the next 3 months. you basically sell the option. Okay. So bounds. Because American call options are never exercised early, when there are no dividends, they are equivalent to European call options, so that C is equal to little c. From equations 11.1 and 11.4, which we showed before, it follows that lower and upper bounds for both C and capital C are given, and the lower bound is the maximum of S0 minus K to the minus RT and S0. These bounds are illustrated in 11.3. The general way in which the call price varies with the stock price is shown in figure 11.4 as R or T, or so this is in the next figure, but let's look at the first figure, which is the bounds for European and American call options when there are no dividends. So S0, they're both bounded above by S0, and they're both bounded below by the max of S0 minus K to the minus RT. And so this is the variation of price of an American or European call option on a non-dividend paying stock with the stock price. So the curve moves in the direction of the arrows when there is an increase in the interest rate, the time to maturity, or the stock price volatility. And so as R or T or the stock price volatility increases, the line relating to the call price to the stock price moves in the direction indicated by the arrows that we see over here. So this is the case when R increases, or when T increases, or when stock volatility increases. Okay. So puts on a non-dividend paying stock. So it can be optimal to exercise an American put option on a non-dividend paying stock early. Indeed, at any given time during its life, the put option should always be exercised early if it is sufficiently deep in the money. To illustrate, consider an extreme situation. Suppose that the strike price is $10 and the stock price is virtually zero. By exercising immediately, an investor makes an immediate gain of $10. If the investor waits, the gain from exercise might be less than $10, but it cannot be more than $10 because negative stock prices are impossible. Furthermore, receiving $10 now is preferable to receiving $10 in the future. It follows that the option should be exercised immediately. Like a call option, a put option can be viewed as providing insurance. A put option, when held in conjunction with the stock, insures the holder against the stock price falling below a certain level. However, a put option is different from a call option in that it may be optimal for an investor to forego this insurance and exercise early in order to realize the strike price immediately. In general, the early exercise of a put option becomes more attractive as S0 decreases, as R increases, and as the volatility decreases. So let's look at the bounds. From the previous work, equations 11.3 and 11.5. Let's look at 11.3 and 11.5. This is 11.3 over here, and this is 11.5, and this is 11.5. Okay. So what we have For a European put option, when there are no dividends, we have that the price of a European put is bounded above by k to the minus RT and bounded below by the maximum of k to the minus RT minus S0 and 0 for an American put option on a non-dividend paying stock. The condition is bounded below becomes that P is greater or equal to P. So okay, the condition is P is greater than, the maximum of K minus S0 and 0, because the option can be exercised at any time, and it has to be worth at least as much as its intrinsic value. This is a stronger condition than the one for a European put option in equation 11.5, okay, which is actually this part over here, okay. Using the result in equations 11.2 for an American put option on a non-dividend paying stock, we have that the put option we've already seen that has to be less than or equal than its strike. Okay, so figure 11.5 illustrates these bounds, the bounds for European and American put options when there are no dividends. So figure we see, so this is P, the European put price is is this region. This is the maximum of K to the minus RT and minus 0. This is K to the minus RT. So this is the European put price which is in this region. And the American put price is in this region, which is the max of K minus S0 and 0. And so this is K, this is the max of K minus S0 with respect to S0. And this is the American put price, which is in this region. Okay. Figure 11.6 shows the general way in which the price of an American put option varies with S0. As we argued earlier, provided that R is greater than 0, it is always optimal to exercise an American put immediately when the stock price is sufficiently low. When early exercise is optimal, the value of the option is K minus S0. The curve representing the value of the put, therefore, merges into the put's intrinsic value, which is K minus S0 for a sufficiently small value of S0. In figure 11.6, this value of S0 is shown as point A over here. The line relating the put price to the stock price moves in the direction indicated by the arrows when R decreases, when volatility increases, and when T increases. And so that's what we see. This is a variation of the price of an American put option with the stock price, and we see at S0, at when S0 reaches A, then it converges to this line over here, which we see over here. Okay. So the curve moves in the direction of the arrows when the time to maturity or stock price volatility increases, or when the interest rate decreases. Okay. Because there are some circumstances when it is desirable to exercise an American put option early, it follows that an American put option is always worth more than the corresponding European put option. Furthermore, because an American put is sometimes worth its increasing value, it follows that the European put option must sometimes be worth less than its intrinsic value. This means that the curve representing the relationship between the put price and the stock price for a European option must be below the corresponding curve for an American option, as we can see. So figure 11.7 shows the variation of the European put price with the stock price, as we can see over here. Note that point B in figure 11.7, at which the price of the option is equal to its intrinsic value, must represent a higher value of the stock price than point A in figure 11.6, because the curve in 11.7 is below that in figure 11.6, as we can see. So point E in figure 11.7 is where S0 is equal to 0. The European put price is definitely K e to the minus RT. Okay. So let's stop sharing and go back to our slides. So this is upper and lower bounds for European or American coal price, which is between max S0 K e to the minus RT and 0 and S0. Should puts, so should puts, are there any advantages to exercise an American put when S0 is 60, T is equal to 0.25, R is equal to 10%, and K is equal to 100? The answer to this question is yes. So bounds for European and American put options with no dividends, which is what we just saw, the European put prices in these regions, the max of K to the minus RT minus S0, this is with respect to S0, and it's between K to the minus RT and that line over here. For the American put prices in this region, which is max of K minus S0 and K, this is also with respect to S0. And so the impact of dividends on lower bounds, so let's see. Okay. The results produced so far in this chapter have assumed that we're dealing with options on a non-dividend paying stock. In this section, we examine the impact of dividends. We assume that the dividends that will be paid during the life of the option are known. In many situations, this assumption is often not too unreasonable. We will use D to denote the present value of the dividends during the life of the option. In the calculation of D, a dividend is assumed to occur at the time of its ex-dividend date. And lower bounds for calls and puts, we can redefine portfolios A and B as one European call plus an amount of cash equal to D plus K e to the minus RT, and portfolio B, one share. And we can just use the same argument as the one used to derive that lower bound that we had before. And it shows that the price of the call option is greater than or equal, a European call is greater than or equal than the max of S0 minus D minus K to the minus RT and 0. We can also redefine portfolios Cs and Ds as one European put plus one share, and portfolio D as the amount of cash equal to D plus K to the minus RT. A similar argument to the one used to derive the previous equation, the previous bound that we had before, 11.5, shows that the price of a European put is greater than or equal to the max of D plus K to the minus RT minus S0 and 0. So when dividends are expected, we can no longer assert that an American call will not be exercised early. Sometimes it is optimal to exercise an American call immediately prior to a next dividend date. It is never optimal to exercise a call at other times. This point is discussed further later on. But okay, so put call parity, comparing the value at option maturity of the redefined portfolios A and C, shows that with dividends, the put call parity result in equation 11.6 then becomes, you just do the exact same argument as before, portfolios A and C, which we have over here. C is 1 European put option plus 1 share, and portfolio A is 1 European call plus an amount of cash equal to D plus KE to the minus RT. And so then the put call parity becomes C plus D plus K to the minus RT has to be P plus S0. Dividends cause equation 11.7 to be modified. And so now the difference between American call and put are S0 minus D minus K and S0 minus K to the minus RT. Okay. And so let's stop sharing. Go to the, and so, yeah, we have this, so the impact of dividends on lower bounds to option prices, we have that C is greater or equal than S0 minus D minus K to the minus RT. And the European put price lower bound is greater or equal than D plus K to the minus RT minus S0. So for American options, when D is equal to 0, C minus P is between S0 minus K and S0 minus K to the minus RT. When European options, the put call parity, excuse me, is that C plus D plus K to the minus RT is equal to P plus S0. And the American options and the extension to the American options when there is a dividend, which is greater than 0, is that C minus P is now greater than S0 minus D minus K and less than S0 minus K to the minus RT. And this is the end of our slides. And this is the end of our lecture today. So this is the end of lecture number 10 of STAT 761.